Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Sanjana Prabhakar. She's the index research specialist with Nasdaq Investment Intelligence to discuss the strength of a dividend-based strategy and why it is compelling given the current macroeconomic environment. Sanjana, it's great to see you as always. Welcome back to Trade Talks. And before we get into your charts here, give us a high-level overview of why investors should be thinking about dividend-based strategies.
Yeah, sure, Jill. So as you mentioned, odds of a recession today are quite high. We have economists now peg the odds at about 65%. And what we believe is dividend indexes are likely to offer relative safety during a recessionary environment, just given their inherent characteristics. What we have seen during past downturns, we see equity markets decline along with earnings and output. While stock prices have proven to be volatile, dividends have proven to be less volatile. And that's something worth noting.
Yeah, it certainly is. Let's get into your charts here. Tell us about the sector diversification and the strength of the construction.
Yeah, sure. So as you can see in the chart here, the top 20 names make up about 50% of the index weight and consist of companies operating in a broad range of industries, as diverse as consumer staples, telecommunication, utilities, and financials. So that gives you some indication for how diverse this index is. And to provide some further color into the top 20 names, you see some household names such as Walgreens, Verizon Communications, and IBM. As we all know, Verizon is a well-known provider of communications, information products, and services, and serves approximately 115 million retail customers. That's about 7 million broadband connections, suggesting a very large user base. We also see representation from a community-oriented financial services company, Northwest Bankshares, which offers a range of financial services products. This company actually registered its 112th consecutive quarter of paying out cash dividends last year, and that's something worth noting. What's common to all these companies is their strong dividend profile.
Right, and then you also add an extra layer of screening through the highest dividend yield names.
Yes, Jill, that's right. So as you can see, the securities that make up the DAY index are selected from a broader index that we have, the DAA. We screen for the top 50 names by dividend yield. So the primary level of screening involves selecting companies with at least 10 consecutive years of increasing annual regular dividend payments. And the secondary level of screening involves selecting those companies with the highest yield. And we have some additional constraints here that we have highlighted. And as you can see in the second box here, no single sector can have more than 12 securities. And additionally, no single sector can have a weight of more than 25% in the index. And no single stock can have a weight of more than 4% in the index. And that's something that we wanted to highlight.
And you had mentioned at the top that these types of dividend profiles have the potential to provide a buffer against a recessionary environment.
Yes, Jill, and that's something we wanted to draw our readers' attention to, our viewers' attention to. If you can see in slide 3 here, you can see the performance dispersion among the top 20 names. More than half of the top 20 names registered positive returns in both fiscal year 2021 and fiscal year 2022. While the average full-year returns across the top 20 was a loss of 9.9%, the average gain of the top 50 names was about 2.9%. What we wanted to flag was there were company-specific headwinds, such as weaker demand and fundamentals, which impacted names such as VF. The overall dividend profile remains strong for all these top 50 names. And as you mentioned earlier, it's likely to act as a tailwind in a volatile market.
And finally, what about the performance of this particular index versus a broader market, the S&P 500?
Yeah, and I think this is the most interesting segment of our research, which we have tried to capture in our final slide here. As you can see, in 2022, the index registered a total return of 3%, significantly outperforming the S&P 500 index on a relative basis by greater than 20%. And that's something quite noteworthy. I think it points to the importance of allocating dividend strategies in a choppy market. And if you also look at a longer time horizon, if you go back and look at the performance over the past 10 years, you see that the DAY has outperformed the S&P along with several competing high dividend indexes. And I think what this suggests is that investors are likely to benefit from getting concentrated exposure to this basket of 50 high quality US securities.
All right, Sanjana, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you very much, Jill.